The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 of Bloomberg headquarters in New York, I'm Alex Steele.
And I'm Matt Miller. We're kicking you off to the closing bell here in the U.S., where we didn't see a lot of action on the index level, but a ton is going on under the hood.
Yeah, really fun stuff going on, particularly if you look at semis. So take a look at where we sit right here. The S&P is flat on the day, as Matt was saying. Not that exciting to write home about, but you are seeing the Mag 7 sell off. It's an Apple and it's a Tesla story. You're looking at the NASDAQ 100 off by 0.1%. And I wanted to put in the yield market just for fun. So you're seeing a 10-year yield down 4 basis points. Again, not a huge move after that big move we saw yesterday, but nonetheless, we're kind of reversing that risk management that higher yield bias, Matt.
Yeah, and big beats for big banks continue. 6 out of 6 of the major financials that reported over the past 2 days have beat on net interest income expectations. Morgan Stanley coming out and saying M&A pipelines are at the highest level in 7 years for that bank. It's a different story, though, in the healthcare space, with United Health reporting higher patient care costs and revenue that fell short of estimates. Many analysts say higher costs are going to be an overhang trend heading into the rest of the year. But today's retail sales data could be a good sign for earnings yet to come. The numbers showing sales broadly increased in December, indicating strong consumer demand to wrap up the holiday season. 10 of the report's 13 categories posted increases. And then, of course, tariffs. We're still talking about them. They loom large as President-elect Donald Trump is set to take office on Monday. Scott Bessent, Trump's pick for Treasury Secretary, is on Capitol Hill today for his confirmation hearing. The hedge fund manager says the administration would use tariffs to make trade more fair for Americans. And senators, of course, grilled Bessent on the debt ceiling, on health care costs, and on inflation, Alex.
Yeah, good stuff. We'll get to all of that throughout the next couple hours. Let's circle back to what Matt was talking about in terms of earnings, right? You got the big banks, you got some regionals, you have United Health. This shows the earnings scorecard pretty much every quarter going back for years. We're focused on right here, that 7.8% earnings growth for the fourth quarter of 2024. That's what we're in right now. Not a huge change from the last year when it comes to earnings, right? Not amazing like we saw back in 2021, but not negative like we saw in 2023. So the question really is going to be twofold. It's going to be what their expectation is. It's just an expectation game, right? Like we're going to underpromise and overdeliver. What does their outlook look like? And what about costs, margins, and the dollar? Those three things kind of swirling about in all the different sectors as we move forward, Matt.
All right, let's talk about this more with Anastasia Amoroso. She is Chief Investment Strategist with iCapital, and she joins us here on set. Anastasia, first of all, welcome. Thanks for joining us. In terms of these bank earnings, all big beats. Right. What do you think of them specifically? And is there any read across to the broader economy?
Absolutely. First of all, I think the way I would describe them were blockbuster earnings, Matt. And it's not just in terms of the beating on the current quarter, but really guiding and the outlook that we see for this year. And when you look, for example, the capital markets activity was very strong for this quarter. But if you look at the consensus forecasts and some of the commentary that came out around those forecasts, it's really positive. So most of the banks are expecting the capital markets activity, specifically from the advisory fees, from M&A advisory, to really tick higher. And that has a lot of read-throughs that we can talk about. The other thing that I thought was notable is that there's been some positivity around net interest income for banks. But if you look at consensus expectations, they're very subdued. And in fact, they're looking for maybe 1% NII growth in 2025. But I think that could be one of the surprise factors is if we see better loan growth from banks this year, and if we still see somewhat lower interest rates and steeper yield curves, I think that's where the banks can beat on going forward.
Well, the banks are kind of sandbagging there, right? Remember, JP Morgan a couple months ago said NII for 2025 was only going to be $84 billion. They said analysts are getting ahead of themselves. Then they said, well, okay, maybe it's going to be 90, and then now they're saying 94.
Right. Yeah. And they guided higher. Maybe that's the reason why some of those NII numbers are still subdued, but they get revised higher when the results come in.
Can I just ask on the loan growth? Yesterday we talked to Mike Santomassimo on this program, the CFO of Wells Fargo, and he was saying, M&A advisory fees were higher in the last quarter, right? As we start to get more positive corporate animal spirits heading into Trump. But the loan growth isn't quite there yet. Even though small business expectations are high, they haven't really acted yet. And Trump's coming to office on Monday.
No, they haven't. And part of the reason was that interest rates have been elevated for the bulk of the last 2 years. But if you look at auto loan interest rates, if you look at credit card loans, if you look at just the SOFR rate and the term SOFR, off of which a lot of those smaller business loans are priced off of, it has started to move lower. And it's essentially 100 basis points lower where it was than just 6 months ago. So I think over time that does start to feed through those animal spirits, and that does start to feed through to some of that lending growth. So if it's running at 2%, maybe we could see 3 or 4% loan growth this year. And obviously the economy has to deliver on that 2 or 3% GDP growth for that.
But Matt, to your point, I mean, you look at U.S. Bancorp and PNC today. U.S. Bancorp's worst performing stock in the S&P, and part of that is why? Because of the weaker loan demand. So Anastasia, if we broaden it out for a second when it comes to earnings, I was saying you're looking at 7.8% earnings growth. Like, where are we going to get the most bang for our buck in that earnings season?
Yeah, I mean, where you're going to get the most earnings growth is from the financial sector. And of course, financials, versus banks, there's a pretty big distinction there, benefiting from the capital markets activity. And then you have to go to the true and tried technology names and the communication services names. So that's what's really likely to deliver the greatest earnings. Now, maybe consensus estimates have been revised, or, they would not been revised down significantly, but I still think you'll get 3 or 4% earnings beat going forward. And, that's really sort of the read-through from earnings to the markets. Is markets have been grappling with policy uncertainty and rate uncertainty. But I think especially this week, speaking of confirmations, we've had some positive confirmations in terms of companies seeing very robust earnings growth, which should bode well for this year for markets.
So you think that earnings growth for technology is going to be enough to move the needle? It's not already priced in when you take a look at its ratio?
Well, typically, it is to an extent priced in, and yet the bar typically gets reset low enough for the companies to come in and beat those expectations.
So it's priced in, but by the time we get there, it won't be made.
Well, as Matt was saying, maybe you don't guide quite as high as you think you might deliver, and so typically we see 70% of the companies beat on earnings expectations, and on average, it's been about a 4% earnings surprise. So I think we can have that sort of average quarter, but what's also important is the guidance, and we've seen it be very positive from financials. I think another point to make here is TSMC came out with their earnings results, and the long-term guidance has been really positive on AI and AI capex.
So if S&P earnings are 15% and they beat, and economic growth is 3% or more, inflation headed down to 2%, the Fed can still cut. That's awesome. But what if the Fed can't cut as much because inflation doesn't head down to 2% and we get rates back up to 5% on the 10-year or even 5.5%?
Right.
Is that a risk?
Well, that's what I call a wild card, and that's been our outlook going into this year. Is I think the U.S. economy, the earnings have very solid underpinnings, but there's a number of wild cards that have to do with tariffs and taxes and budget deficits and the rate backdrop. So to the extent that we don't get further rate cuts, I think they mitigate the upside for the S&P somewhat, but I don't think they erase it, because the reason why we wouldn't get the rate cuts most likely is because growth is so strong that inflation is sticky, and in that environment, you still have that earnings growth rate offset, even if you have a higher discount rate, which is why, coming into this week, I've been thinking this is emerging to be a buying opportunity in markets because, yes, there's some negatives in terms of policy uncertainty or rate uncertainty, but the positives are the AI momentum that's carrying over from 2024 and certainly the earnings momentum that we're seeing.
And the growth momentum in the economy, as you point out, that's a different 5% 10-year than otherwise. Right. All right, Anastasia, thanks a lot. Really appreciate it. Anastasia Amoroso, Chief Investment Strategist with ICapital. We appreciate that very much. All right, coming up, incoming Trump administration tariffs and sanctions could have a massive impact for the oil sector. We're going to break that down with Ed Morse, Senior Advisor over at Hartree Partners.
Legend. Plus, it's the electric vehicles slide for Polestar with the stock down 10%, decimated. But it's not all bad news for EVs because shares of Rivian are revving higher as they get a last-minute 11th hour $6 billion loan from the Biden administration. We'll talk about that in the space.
All right, shifting gears, love the puns from cars to trucks. JB Hunt earnings are out after the bell. Shares are up over 9% in just the first 15 days of the year. We'll break the results as soon as they hit the tape. All that and more coming up. This is The Close on Bloomberg.
pipelines in the M&A product that are the highest in 7 years. So that is really encouraging. Now, some of this will be dependent on how things roll out in the first couple months of the incoming administration and how things feel on a cross-border basis.
Now, CEO of Morgan Stanley, Ted Pick, on today's earnings call, seeing that uptick in M&A pipelines. Speaking of, hours later, Bloomberg breaks the story that potentially Rio and Glencore could be teaming up for a behemoth in the commodities market.
Yeah, I mean, we're only just over 2 weeks into the year, but pretty much everyone in the world expects M&A to rocket back up to record levels as regulations fall away, antitrust concerns maybe dwindle, and this would be a massive, massive deal.
Yeah, and it's not just sort of the small companies or like tack-on deals. Like this would be, $55 billion of Glencore and $103 billion of market value of Rio Tinto coming together. That is no joke.
Yeah, absolutely fascinating to watch. And, we'll see what happens, but it would become the second biggest miner, right, in the world? Or would it be even bigger than BHP?
It would be bigger than BHP,
Yeah, okay.
and it would definitely be a copper play. Ed Morse is coming up in about 15 minutes. We're going to ask him about this in just a moment. So going back to Morgan Stanley here. So shares are up almost over 3% after results showed their fourth quarter profit more than doubled. The numbers are just really great. Here to break it down is Chris Kotowski, Managing Director and Senior Analyst at Oppenheimer Co. I was asking Allison Williams of Bloomberg Intelligence, like one word to describe the banks. She said green. And like they're just making money after money after money. What would be your one word?
Well, I think the thing is, the reports were all at or better than expectations. But in particular, it was driven this time by the trading desk. So trading profits for the companies that we had were up like 27%. And we were expecting 10 to 15. So that's what blew out. Now, the notable thing there is, though, those companies that had those great trading results, they had really good operating leverage because, the expenses were pretty well contained. And, the trading results, they're obviously volatile and you can't take that to the bank. But on the other hand, it kind of feels like that we're at a new, more volatile, higher level with trading. And to the point you were making just a minute ago, I do think that there is an M&A wave coming at us. If you look at 2024, in terms of M&A activity, it was the lowest year in closed dollar volume since 2014. And nominal GDP is 70% higher today than it was in 2014. So, this has the potential of being a much, much more than just incremental kind of rebound.
So what does that cycle then look like? If it's not just a rebound, but like a real shift here, what do you think that looks like?
I think there's a lot of pent-up demand. In addition to the banks, I cover a lot of the private equity asset managers. A lot of them, ever since rates have been started to rise, kind of M&A activity has been choked off. So this is going on 2-3 years now. And so a lot of them are sitting on assets that they would like to monetize, that they would like to sell. And there's plenty of dry powder out there. And you have rates, kind of peaked and have come down a little bit. So that makes cost of capital much more predictable. And then, obviously you have the regime change at the FTC, which, was incredibly restrictive previously and is probably going to have a more normal approach going forward. So between pent-up demand, rates coming down and fewer regulatory obstacles, I think you're probably, again, you're looking at something I think nobody knows how big it's going to be, but it's going to be better than incremental.
Chris, so cool that you cover these two closely related, but still, for the most part, separate universes. Blue Owl on one hand and J.P. Morgan on the other. We saw the Citi deal with Apollo. If you can't build it in-house, maybe you join them somewhere else. But how do you think these big money center banks are going to do when they're trying to get claw back some of that lending business from private credit?
I think that train has come and gone. And the banks have, ever since the great financial crisis, the banks have de-risked themselves. You go through this annual cycle. It's not just the Biden administration. We've had this annual cycle of stress tests for 15 years now. And, it changes slightly every single year. But the banks now know that if they make risky loans, that they're going to get dinged and they're not going to be able to pay their dividends and do their share buybacks. So the banks, I think, are permanently much more risk averse. And at the same time, you have created this massive infrastructure, of credit managers among what used to be historically private equity guys. They manage trillions of dollars of credit assets and increasingly pushing into investment grade. Apollo last year did an $11 billion investment grade financing for Intel. So it's not just little, leveraged buyout loans anymore. It's really major finance.
Well, and I guess private credit is kind of the sexiest story on the street. On the other end of that spectrum, you get the boring old, deposits and loan business. JP Morgan, as Anastasia Amoroso was just talking about, said that NII is going to be better this year than the street expected. Of course, they were lowballing at the end of last year. Mm-hmm. But what do you think about net interest income and what we're going to see in this rates environment?
Yeah, for the boring old banks, I kind of agree with that. And, what is happening in particular, you've got a tailwind coming from the securities portfolios rolling off. So, the banks have a ton of mortgage-backed securities that they put on in the late 20-teens and early 2020s that have like a 2 to 2.5% coupon. And every month people mail in their mortgage payments and they pay down the principal a little bit. So if you look at the bank's held to maturity portfolio, it's paying down 2 to 2.5% every quarter. And those are loans that, those are securities that have a 2 to 2.5% yield. And that money is being redeployed in cash or short-term securities yielding 4.5 or 5. So that is a tailwind. And then to Amoroso's point, if you get loan growth on top of that, it should be a pretty good story. Not as dynamic as the rebound in M&A activity that I'm looking for, but up and to the right.
Chris, are you surprised by the market reaction for U.S. Bancorp, for example, then down 6% today on that?
Yeah, I thought, quite honestly, all the regionals are down. And, maybe other people had other expectations than I did, though my estimates were reasonably close to consensus. And they were kind of in line with what I was looking for. So, I don't know what algorithm got triggered here today, but I think they'll be fine.
Chris, great having you on the program. Thanks so much for joining us. Chris Kotowski there from Oppenheimer giving us his take on the big banks after 6 of 6 beat. Coming up, watching shares of United Health Group tumble after its latest quarterly report left analysts feeling a bit ill. We'll recap the results next in our top calls. This is The Close on Bloomberg. Time now for our top calls. A look at some of the big movers on the back of analysts' recommendations, starting with Dave & Buster's. Truist's giving the arcade and dining company a street low price target of $27, down from $36 as the stock hits a 7-day losing streak. The analyst doesn't see much visibility in same-store sales and suggests that executives do a better job with its marketing efforts. He keeps a hold rating on the shares. Dave & Buster's currently down 2.25%.
All right, Matt, it is dog day afternoon for shares of software company Datadog. Morgan Stanley cutting its rating to equal weight from overweight. Price target set at 143. Analyst sees increased risk for slower growth, at least until an AI-related catalyst emerges. Nevertheless, he is still positive on long-term buying opportunity. Shares down about 3%.
And finally, Southwest Airlines facing some turbulence after Citi analyst Stephen Trent bumped his recommendation to sell from neutral. Trent says earnings quality and free cash flow conversion look weaker than they did before the pandemic, leading other U.S. airlines to overtake Southwest on those fronts. Maybe he went from neutral to sell, actually. I'm going to correct myself. It is now a sell there, and the target $29.50.
There you go. Good job.
Let's turn now to one of the most talked about stocks today. That's United Health Group. Shares taking a hit after fourth quarter sales missed estimates, in part due to higher patient care costs. It was also the company's first quarterly report since the shooting death of United Healthcare CEO Brian Thompson. Joining us now to help recap those results is Bloomberg's Jon Tozzi. And Jon, it does look like they're having to pay out for patient care a bigger percentage of their premiums.
Yeah, so what's driving the stock down today primarily is results from what's called the medical loss ratio. It's basically a metric that shows what percentage of health insurance premiums are paid out for care. So there's sort of two variables there. There's the premium income, the premium revenue they're taking in, and the expenses that they're paying out. And both were affected, and the ratio was higher than Wall Street expected, putting some pressure on earnings.
Jon, I guess the question is why? And how long does that trend last for?
Yeah, so I mean, broadly, insurers, not just United Health, but across the group, have been seeing pressure on their medical loss ratios for more than a year. There's a lot of things that go into it. Changes and stricter payment policies from government programs like Medicare, increased use of care. There are also some sort of unusual things on the revenue side that the company flagged this quarter that they don't expect to repeat next year. So I think some analysts were taking that into account. But overall, this has been an issue for the group. Going back into 2023, where they are seeing elevated medical costs and pressure on the revenue side.
All right, Jon, thanks a lot. We appreciate it. Bloomberg's Jon Tozzi joining us there. So I wonder how long that cycle is going to last, particularly as medical costs were supposed to come down.
Yeah, well, medical costs never come down, right? In this country.
Well, drug costs should have been Inflation
because we're footing the
Act,
bill for the rest of the world. But
that's a different story.
Look, my question is it an industry-wide problem? Are we going to see bigger payouts for patient care as a portion of premiums for all health insurers?
I mean, I think the answer to that's probably yes. It just matters how long that cycle actually plays out for. All right, coming up, we're going to talk to Ed Morse, the man himself, senior advisor at Hartree Partners. We're going to talk about the impact of tariffs on the energy market, sanctions as well. We'll also see what's in it for a Rio Glencore tie-up. This is The Close on Bloomberg.
If I'm confirmed, and if President Trump requests, and as part of his strategy to end the Ukraine war, that I will be 100% on board for taking sanctions up.
That was Treasury Secretary nominee Scott Bessent being very clear on what his roadmap to sanctions on oil majors who are doing business in Russia might be if that is the directive from President Trump.
Yeah, I mean, it could go either way, right? We could see tougher sanctions if Putin doesn't do what Trump wants him to do, or you could see a little bit of a carrot dangled if Putin goes the direction, out of Ukraine that Trump wants.
And we also heard that potentially we'll see sanctions on Venezuela, Iran, and Russia. That was reported earlier in the day, and that really ramps up then the oil supply, or actually crushes the oil supply a little bit. So joining us now for more on this is Ed Morse. He's senior advisor at Hartree Partners, has been in this industry for decades and decades, and has great perspective on this. This is not your first rodeo with sanctions here, Ed. What do you think the actual reality will be when it comes to sanctions on Iran, Venezuela, and Russia in the Trump administration?
So I don't think they're going to rush into sanctions the day of next Monday or the day next Tuesday when the administration, takes office. I think they'll be doing a lot of things. We hear about 60 or 70 executive orders coming through, but I think tariffs and other kinds of sanctions are going to be put in the background. It'll be a little bit of a wait and see what's going to happen, but and that includes, the threat on the tariff side of the 25% across the board tariff on all imported goods. So I think it's been overstated, but for sure Iran is in the near-term sights.
Right, which begs the question, I mean, and Scott Bessent said it in his testimony today, he was like, a big part of this is going to be incentivizing U.S. producers to produce more to offset any sanction risk from Russia, Iran, and Venezuela. Do you think that oil producers in the country with $78 WTI feel the same?
Well, there's a little bit of a contradiction there. So, Trump certainly has said that he wants, as the highest priority he has, to bring energy costs down in the United States. And the second one is to unleash the power of U.S. dominance in the energy sector. Now, those two things don't go along exactly perfectly. If we bring down energy costs through prices by 50%, it's not going to be good for the U.S. industry. And certainly lifting sanctions on Russia, lifting sanctions on anyone else that we have them imposed on is going to increase the amount of oil and natural gas available, and it's going to make marketing that increased production that the administration is looking for all the more difficult, and the prices are going to make it all the more difficult for companies to invest that capital, given the uncertainties about what that means. And just think about what it means. And, we had Russia producing close to 2 million barrels a day more before sanctions than now. We had them producing a significant amount of natural gas. We have had our companies taking up like 80% of that natural gas that the Russians have had to shut in, particularly to their closest partner, Europe. And there's no doubt the Europeans were paying a much lower price for the Russian gas than they would be for U.S. gas. So it gets more complicated in terms of what it does to U.S. industry.
It is. It's mind-boggling to me. I said this yesterday. I've been saying it for a while that Europe still pays Moscow for oil and gas to finance the war that Moscow has waged essentially against Europe. Is there no other alternative, Ed? Why does that happen?
Well, on oil and gas, their exports to Europe are way, way down. And that was where they made most of their money. Now, they certainly have, with the distortions in the market, been able to penetrate other markets. We have a price cap on, and the Biden administration, with, I'm sure, the encouragement of the Trump administration, has tightened those price caps significantly, which will affect, and it's already affecting, the price in the market. It's gone up because of that increase in the sanctions. And we've seen the two largest buyers of Russian oil, in particular, Russia and China, holding back, worried about what those incremental sanctions will do.
When it comes to the price, I know that, we've seen a big jump because of the new sanctions the Biden administration put on Friday. But I was talking with some people down in Texas about the rise in crude, NYMEX or Brent, take your pick. And I said it was surprising to me because I thought we were going into like drill, baby, drill. And they have been saying to me, well, the producers don't have CapEx. Is that really the case, Ed? Are we not set up to pull a ton more oil out of the ground in this country?
Well, I think we are set up. Let me turn back and say, what the drill, baby, drill is all about. So Secretary nominated, Bessent has made it perfectly clear in his 3 threes that one of those threes is U.S. production of oil or clarified liquids growing by 3 million barrels a day by the end of the administration. That's not a very difficult thing to do, given the current rate of spending. And capital spending now is able to deliver around 800,000 barrels a day of liquid production growth per year. And we don't see that changing from this year to next year, the year after, so long as prices are above the $65, $68 per barrel WTI price range. If it gets lower than that, that's another story. But with the consolidations that have happened in the industry, plus the continued increases in efficiency gains, and those gains include laying larger laterals, they include using robotics below the surface of the earth. There are a lot of things that have improved the cost structure. We think by this time next year, the cost structure year on year will be down another 5+% within the U.S. So I don't think that's the right argument. At current spending, we're adding 800,000 barrels a day of liquids, close to 400,000 barrels a day of crude oil. And then the other increments are in natural gas liquids and other liquids in the market, which is what keeps U.S. dominant in this business. So I do think that there is something to the drill, baby, drill, and it has to do with the choice of where to drill. And we've got, I'll just give you kind of the numbers. Average every 5 years, we've had 11 sessions of auctioning off offshore territory. So licensing, we've had 11 licenses every 5 years on average. Biden is going to be doing, he's established by law 3 for 5 years. You can be certain that we're going to be seeing not 3 over 5 years, but closer to 4 every year, starting already in this year. So that's going to make a difference. The Alaskan territory is going to be widened. There's infrastructure there for 2 million barrels a day of exports. We're only exporting a quarter of that. So the cost of the increase isn't that much.
Hey, Ed, before we let you go, we were talking about this earlier, a potential Rio and Glencore tie-up. To me, that's a copper play. We saw Rio and BHP maybe team up, and they didn't. Is this a bullish copper play to you? Like, how bullish is that call still?
Well, it's hard to know how bullish the copper call is in general. Copper is seen as bullish because of a lack of investment over the last few years. It's seen as bullish because of the need for copper and wiring. And what the market, which looks at around $8,000 a ton today, going to maybe $12,000 a ton in 2 or 3 years, that optimism in the market, which would be made more optimistic by further consolidation on the production side, it really hinges on there being no substitutes, no technological innovation, so you can't have aluminum replacing copper, and it really means that we're going to go full speed ahead on battery power around the world. So I'd say I'd be cautious on that.
That's something I talk about with Gary Schilling a lot as well. There was a time when everyone thought there would be no alternative to copper, and then we started to deal in fiber. Man. Ed, thanks so much for joining us. Awesome talking to you. Ed Morse, their senior advisor at Hartree Partners. It's a little nerve-wracking to talk about oil when I'm next to you.
Right.
Because you know what you're talking about.
But then we get paid back in this next segment because we'll be talking about EVs, and then I can say words, and you'll say more words.
We will talk about Rivian when we come back. It is headed higher. We'll talk about the 6.6 billion reasons behind the stock's move today. In our stock of the hour, up next, this is the close on Bloomberg. Shares of Rivian and hydrogen company Plug Power are chugging higher as the Biden administration is poised to finalize billions of dollars in financing for the two in the last few days that they have in office. This, according to people familiar. The financing comes as the Energy Department's loan program faces new threats from the incoming administration, so they want to get as much money out the door as they can. For more on today's stocks of the hour, let's bring in Bloomberg's Jess Menton. I love these stories. Jess, we're talking about multi-billion-dollar loan guarantees and just outright loans for Rivian. Give us the details.
Well, I wasn't surprised when I got the call and they said that you wanted to talk about cars today, because I know that's always on the top of your radar. So especially this, because you're obviously going to have a new administration coming in very soon next week. And so the Biden administration is, like you said, trying to come through, because this is basically a loan program that these companies can tap into from the Department of Energy. And of course, the Biden administration policies toward EV makers were much more pro for that type of growth than, say, when you're thinking about the Trump administration coming in, because we're thinking about especially EV and battery makers, especially if you're thinking about China's position here. They're trying to be more tough on that with potential tariff policies. So you're seeing kind of the Biden administration trying to rush in here and fix that.
It's interesting. You have to wonder too, distinguishing between a Plug Power, which is hydrogen, which is much more dependent on tax credits, et cetera, than say EVs to some extent too.
But Plug Power is going to get a $1.7 billion loan guarantee. Right, to build new
and they better
plants.
hope that the tax credits stay and that Congress doesn't reverse them.
Rivian wants about $6.6 billion for its Georgia plant. But Vivek Ramaswamy says when he gets in there, he's going to scrutinize those loans.
Even if you look at Plug Power year to date, it's already up 30% after it obviously underperformed last year. So it's been on a tear even leading up to this. And especially because people are thinking about what could potentially happen with either a cash crunch, liquidity type issues it may have had in the past. So that's why you've seen this stock potentially, when you're going to tap into more loans like this, really take off in recent sessions, not even just today's.
Yeah, I remember for Sarah Week, which is where the energy guys all go once a year, Secretary Granholm at one point was like, come and get money. Like, we're doling it out. Come and get it in D.C. Everyone's like, ooh, I don't know if we love this. All right, Jess, thanks a lot. Really appreciate it. Bloomberg Jess Menton joining us there. All right, we're like, 15 minutes away from the closing bell?
Yes, we are.
On this Thursday?
Yes, we are. And not a lot going on the index level. Like, compared to yesterday, I was so pumped up. We were up 2% even on the S&P
on 14
at
basis
this time
points,
yesterday.
Right? In the bond market?
15 in the bond market. The biggest drop that we had in 10-year yield since August.
Yep, and now we're just settling out. Now we're settling out. We're going to see where we're going here. You're looking at big caps, though. They have a rally. You have the stocks index also. Semis have a nice rally. Rich Ross, head of technical analysis with Evercore ISI. What did you call him before?
A clairvoyant.
Apparently, Matt.
Ed Hyman said this guy has an actual crystal ball in his office at Evercore ISI. We'll talk to him next. This is Bloomberg.
Where you're going to get the most earnings growth is from the financial sector. And of course, financials, versus banks, there's a pretty big distinction there, benefiting from the capital markets activity. And then you have to go to the true and tried technology names and the communication services names. So that's what's really likely to deliver the greatest earnings.
That was Anastasia Amoroso, Chief Investment Strategist with ICapital, kicking off the show. Remember when we had that chat?
Yeah.
Earlier?
Yeah.
It was fantastic, I thought.
Like an hour, like 15 minutes ago.
Talking about the big banks beating, and she thinks maybe they're sandbagging a little bit and could do even better on net interest income.
And she's also like in tech, also into earnings as well. We saw some positioning rebuild, according to Goldman Sachs data. Taking a look at the market today, though, on the headline level, it's not really going anywhere fast. The S&P is pretty much flat. The NASDAQ 100 a little bit soft, but you have the KBW Bank Index a little soft. But stocks are doing really well. Mid caps are doing really well. And the Russell finally inching its way into the green. It's just that Mag 7, Apple and Tesla, that are really drags right now.
Right. But you know what? There are no bears on tech, are there? Does anybody out there say, I'm like selling the Mag 7?
I don't think so.
I've not heard
prime
that.
broker. Like you had traders selling in October, right? Like before, but I don't think at this point. I think it's a rebuild.
They had a rough couple weeks to start off the year. Let's get some market analysis from the technical standpoint. We bring in Rich Ross. He's the head of technical analysis over at Evercore ISI. Rich, what do you hear about the Mag 7? I mean, everyone's been bullish on them for 2 years. It's rare that you find a bear. Everybody who's anybody on the street reads ISI research. Have you gotten any calls from somebody who says this is a time to sell that stuff?
Well, I think whatever negative you might be able to say about the Mag 7, and you won't get any negativity from me, is really comes around as a positive because people think that breadth will expand as interest rates come down, as inflation comes down, as we continue to get more interest rate cuts. So perhaps it's not an indictment of the Mag 7 per se when you get some pushback, but more so an endorsement of what could go right during the Trump presidency, what could go right for this economy, again, as we come off the boil from the macro in terms of that stronger dollar getting weaker, in terms of those higher interest rates going lower.
Do you buy that in terms of the breadth, the broadening out trade? We've had a couple head fakes for the S&P 493. Is it going to happen this year?
I'm a believer. I still think those Mag 7s the Mag 7 are going to lead. I still think breadth is going to remain concentrated, but I do think the backdrop improves. Obviously, we've had a scare with interest rates surging off those September lows, up almost 100 plus basis points from 360 to near 5%. But fortunately, we step back from the ledge, setting the stage for some of these very hard hit sectors, whether they're, look, the most cyclical sectors got hit the hardest, as they are wont to do when interest rates go up. So now I think you are set up for breadth to start to expand down cap into those small caps, into those cyclical names like your industrials, even to the more defensive interest rate sensitive utilities, which have been both a victim clearly of the tragic headlines, but also of that surge in interest rates. So the shorter version, Matt, is that I do think breadth begins to expand. I'm quite bullish on the S&P. I've got a 7,200 year-end target. You're not going to get to 7,200 just on those 7 stocks alone, but I do think when the dust settles, those will be the leaders at the end of the year still.
When you talk about trickling down, is that trickle down to small caps? Because take a look at a chart, and clearly we're bouncing off that 200-day moving average. Like, that has held, but does that mean that we're actually going to finally surpass the 50 and hold that?
Yeah, I think we are. You know, those small cap stocks still have a very bullish multi-year base. We pulled back, but as you said, as you pulled back to key support, we tested, we stared into the abyss, but we held. That's where you find your true character. You get back on the horse. You can take out that multi-year base on those small cap stocks. But again, you don't want to overplay it until you see the whites of the eyes of inflation and interest rates in terms of a meaningful, more sustained break lower. That is our view. But until we start to get some more corroborative data consistent with that view, you still want to stay the course, stay with that warm blanket of security offered by those large cap, largely technology and financial stocks as well.
Yeah, I was going to say, so over the past 3 months, consumer discretionary, communication services and financials, they've all led the rally within the S&P. What still looks good technically within the S&P?
Yeah, I think you hit on some of it. And look, if you take tech and financials right there, to include communication services, of course, tech, comm, and banks, I think we're talking about 54, 55% of the S&P right there. That's like starting every day on second base. You've seen the earnings coming out of those big banks. So I think top to bottom, the financial sector has the best charts in terms of that breadth underneath the surface across the subsectors. So I think that's a real area of strength. And of course, it's not just in the U.S., but look at those European banks, again, breaking out to new multi-year highs. It's hard to be too negative on risk appetite more broadly when you have credit spreads at multi-year tights, a curve which is steepening, banks breaking out around the world at the same time that technology continues to lead us higher and breadth begins to expand down cap and across cyclicals. So it's a pretty punchy backdrop, and punchy meaning bullish in the technical parlance.
We have, the macro factors that you note, rising yields for one. Alex and I were just talking with Ed Morris, oil industry legend, about those prices. They've been heading north. The dollar, the Bloomberg Dollar Index, has just been on an absolute tear ever since Trump won the election, and that hasn't given up really much of its gains. These things are headwinds, right, for equities. How do you deal with those?
Yeah, look, it's always a dance between the top down and the bottom up. From the top down, we've got pressure. Rising interest rates, rising crude oil, a surging dollar. But again, stocks continue to show a quiet resolve, if you will, and it's not so quiet coming off 2 back-to-back 20+% returns on the S&P 500. So I listen to the macro map, but I also take my cues from equities themselves. I let them tell me how much interest rate we can take, how much dollar we can take before we sort of lose the structural integrity of this market. And from where I stand or sit, as it were, I don't see those signs just yet that equities are ready to kneel in front of those higher rates. And if anything, what we saw this week, again, post that CPI report, it really gave you something to hang your hat on in terms of interest rates starting to creep their way back lower. And just in terms of the dollar, while it hasn't backed off quite yet, go and look at those charts to the first Trump inauguration, 16, 17. You had a surge in the dollar index up out of a multi-year base into the inauguration. And then just as that inauguration came, boom, like a shot out of a cannon, that dollar went straight down. So again, I think history rhymes. It doesn't repeat, the sum of which tells me that interest rates and the dollar, the next move is down. And crude oil, quite frankly, as it stalls into well-defined resistance at $80 on that active contract, while most overbought in over a year.
Hey, Rich, we really appreciate it. Matt has been so excited to have you on the show. He talked about your crystal ball. He really means it. Rich Ross, thanks a lot. Head of technical analysis over at Evercore.
I wanted to ask him about Bitcoin. Vonnie Quinn has a massive stash. I can't believe she still works here. We're looking at $100,000 once again on the Bitcoin price.
Yep.
And that's a place where you really need technical analysis.
Oh, yeah.
Because there's not much else.
That is super whippy. We are moving closer to the closing bell. We're almost there. We got full market coverage for you right here on Bloomberg Television.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
All right, about 2 minutes away from the end of the trading day. I'm Alex Steele alongside Matt Miller here to help us take us through the closing bell. We got a global simulcast for you. Carol Massar, Tim Senovic, and Vonnie Quinn bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the day. We are sort of picking up steam, say, in the mid caps or the Russell or the semis, guys, but still big tech underperforming, Carol.
Oh, my God. And, you take a look at kind of the day's movements. We're kind of just all over the place. I call it a meh trade because it's nothing super exciting. But you look at the S&P 500 still, Alex, and you still have about 377 names actually gaining some ground despite kind of the overall very mellow trade among the major equity averages.
Yeah, I'm all taking a look at Bitcoin, as I like to do. It's at $100,000 per Bitcoin, up about $800 today. So we are seeing some buying there, Vonnie.
Yeah, and also we had some comments from Fed Governor Waller to the extent that there might actually be more than 2 rate cuts this year if inflation continues on its trajectory. And that sort of sent some good vibes towards the bond market, right? That and the Scott Bessent Treasury hearing.
Yeah, I saw the 2-year yield. If you look at the GIP, it just drops when Waller made those comments on CNBC, saying maybe we could get 4 rate cuts this year. And I think that's really what moved the market in that sense. Nonetheless, after those drops in rates, we didn't see much of a rally in stocks. We didn't see that move ripple across other assets like we did yesterday when you saw rates move. So I don't know if the market really buys it quite yet. You need to see more inflation data, more tame inflation data before the market really eats into it.
And speaking of, there is the closing bell. We're a little bit softer. Look at that NASDAQ. We're closing out about 0.9% lower, down by 174 points. Looking at S&P, off by about 0.2%, and the Dow Jones Industrial Average off 0.1%. Volume pretty mixed when you look at the 30-day average, guys. But the Russell and mid-cap seem to be ending the day a little bit higher, Carol.
All right, I'm going to go back and just remind everybody, still most names in the S&P gaining some ground today, just 124 declining in today's session, Vonnie. So, yeah, still a little bit, of a positive tilt. But, you look at just the major averages at the close here, and it doesn't look like much of anything.
And all that's reflected, of course, in the map of the S&P 500, where you see, information technology, communication services, consumer discretionary, the 3 down sectors. However, much of everything else was higher. It was really kind of a tale of 2 chips as well. We had China putting on a probe onto the export of U.S. chips, and at the same time you had results out of TSMC that showed more capex spending for chip makers. So that sort of had a push-pull to this market as well.
Yeah, TSM, certainly one of my gainers here. So let's start there. Thank you, Vonnie, for that. Taiwan Semiconductor, folks, at its highs up more than 7% in today's session, finishing the day with about a 3.9% gain. We're talking, of course, about the ADRs jumping. The world's largest supplier of made-to-order chips did come out with an upbeat outlook, fueling some hopes of some more AI spending this year. Specifically, they forecast quarterly sales and capex for 2025 ahead of analyst estimates, driven by strong demand for AI hardware. So you really saw a bump up in that one. Having said that, the news out of Taiwan Semi boosted shares of some other semi names, and that included KLA Corp. That one off its highs. At its highs was up almost 9%, but finishing the day with a gain of about 4%. And we did see certainly that one an outperformer. I think you guys were talking about it. I think a lot of us here at Bloomberg, we had Richemont hitting a record in the European trade, carrying over to the United States. We're talking about the ADRs up about 17%. I think they also hit a record in today's session. This had to do with the company coming out and talking about its third quarter sales, helping to revive sentiment toward that luxury sector that has really been beaten down. So some upbeat news out of that.
That's you, Carol, right?
Yeah, exactly.
Shopping jewelry at Richemont.
Yeah, I got a kid in college. Yeah, I don't shop for anything for myself anymore. But yeah, so definitely you saw Tapestry. I think you saw Estee Lauder, some other names up a little bit higher. And then just real quickly, I want to squeeze in. We did get about 2 o'clock Wall Street time. You had the news coming out that Rio Tinto and Glencore may be said to be talking about a potential combination, according to folks in the know. Finished off its highs, but you did see Glencore finishing the day up about 2
What do you think of when you hear the word tapestry?
I don't think of Coach.
I think of painting.
Carole King.
Carole
I know.
King.
That's what
Thank you very much. I always think of Carole King every time I hear that word.
I think of Martha's Vineyard for some reason.
This is a word association. This will be our next segment.
I thought Carol Massar would also think of Carole King.
I do. My sister Ellen had the album growing up, so
Aw.
I did listen to it. I don't think of Coach. Sorry, Coach.
Yeah, no, me neither. All right, Tim, what do you got?
All right, what do you guys think of when I say worst performer on a points basis in the S&P 500 and the NASDAQ 100?
I say United Health.
Apple.
Apple.
Oh.
Yeah. That's not the Dow, though. The Dow. You'd be right, Alex.
Okay.
Apple shares falling today, 4%, the most going back to August of 2024. The company extending this recent slump. It's underperforming the market. Lowest going back to November. The stock down about 8.9% so far this month. It's down 12% from those late December all-time highs. No fundamental news today, but the stock has been under pressure. We've reported on this all week over concerns over iPhone sales in the Chinese market specifically. We'll hear from Apple in just a couple of weeks. Bank of America, though, we did hear from them this morning. Shares falling today by just about 1% on the day. You can round that up. The bank's net interest income for the fourth quarter beat the average analyst estimate, though results were partially offset by higher expenses. So why did the stock fall today after this report? Well, we posed that question to Allison Williams at Bloomberg Intelligence. He said that thanks to yesterday's results from the other banks, a lot was baked in terms of expectations to Bank of America. After all, shares were higher yesterday by about 3%. And finally, there it is, Alex, United Health Group down 6% today. Shares fell after elevated medical costs remained in the fourth quarter. Revenue missed estimates. Also, this morning's earnings call was the first time its executives publicly have addressed the December murder of Brian Thompson since that incident. United Health CEO Andrew Whitty acknowledged the frustration with the U.S. healthcare system and said United Health was in a position to help reduce friction for consumers. Shares down 6% today.
All right, guys, I'm just taking a look at the bond market here real quick. We're seeing buying pretty much across the curve, but after yesterday's dramatic move in the bond market, this doesn't feel that exciting. The 10-year yield is down by just about 4 basis points. We did get lower yields when you had Chris Waller on an opposing network talking about how there could be 3 to 4 rate cuts this year, depending on the data. I didn't say
I don't care where it happens. I want to tell our viewers and our listeners the info, right? So they can act on it.
All right. I said another network, but whatever, we'll go with that. Anyway, and so you saw pretty much buying there on the long end. Scott Besson not talking today necessarily about where he'll issue on the curve either. That was really front and center for those bond guys, Matt.
Were you wondering about J.B. Hunt?
Always.
Earnings? Let me break them for you. In case you're watching for J.B. Hunt earnings, I'll tell you that fourth quarter EPS was $1.53, and we were looking for $1.63, so missing by a dime. Intermodal revenue was $1.6 billion. The estimate was $1.57 billion, so beating by a smidge on intermodal revenue. In terms of dedicated revenue, and we're going to get Lee Klaskow on later to clarify what this stuff means. Dedicated revenue, $838.5 million. The estimate was for $849.6 million. And then total revenue, which is much easier to understand, $3.15 billion. That is bang in line with the $3.15 billion that Wall Street forecast. But the bottom line, Carol, is they missed by a dime at J.B. Hunt. What does that say about the trucking industry? We're going to talk to Lee Klaskow about it a little later on the show.
I just like how you say intermodal. I don't know why, but I just do. All right, so let's move along to some of the interesting stories on our radar. And one that really caught our attention has to do with MBAs, and particularly Harvard MBAs. Apparently the school coming out and saying 23% of job-seeking Harvard MBAs who graduated last spring still looking for work 3 months after leaving campus. That share is up from 20% previous year during a cooling white-collar labor market. Remember back then, the figure was 10% back in 2022, according to the school. So they're not the only one, Tim.
Yeah, this is something we saw in the Wall Street Journal, and it's getting a lot of attention today because more than a dozen of these top-tier MBA programs. We're talking about Wharton at University of Pennsylvania. We got Stanford's Graduate School of Business, Stern down at NYU. Vonnie, they all had worse job placement outcomes last year than any other in recent memory.
Well, I mean, it is the McKinsey point, right? The top of the top is where you need to be. And I guess companies seem to be not doing what we used to call the milk round anymore. They don't hire in advance. They just hire at the very end of the year or even after students have graduated. So in some cases, in the highest Ivy League schools, more than 20% of kids or, MBA grads, they don't have to be kids, are still hunting 3 and more months afterwards. What we're keeping an eye on, though, is the cold weather, because it's about to get even colder. And for the TikTok CEO, who apparently is going to be celebrating on Sunday and Monday in Washington, D.C., I hope he has a jacket with him because apparently temperatures will drop to 24 degrees Fahrenheit.
That is an awesome story.
Without the wind chill.
By the way, in 2020, Donald Trump used IEPA, the International Emergency Economic Powers Act, to ban TikTok. Now, 5 years later, he's inviting the CEO of TikTok to the inauguration.
What do you make of it?
To sit with Mark Zuckerberg and Jeff Bezos and Elon Musk and all of the former presidents who are going to go. It's just an amazing.
We're talking about the weather.
They're going to have to keep each other warm.
It's going to be cold.
I thought it was a weather story, right?
I just want to hear what
cool weather
Matt.
story.
What am I supposed to say about the weather?
Like, are they going to get out and walk, during the inauguration like presidents have been doing? I don't know.
Supply and demand, heating oil prices.
There's that too.
The grid.
The mitten index, all that good stuff. All right, guys.
God makes the weather like this.
All right. Intermodal.
Which one?
Intermodal. All right. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. A little bit wacky there, but that's how we are on this Thursday. All right. We'll see you again. Same time, same place tomorrow.
Coming up, we have a deeper dive into the trucking industry. As I was saying earlier, we're going to break down those results from J.B. Hunt. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Bonnie Quinn.
And I'm Matt Miller. Let's take a look at where the markets closed out the day. There wasn't a ton of movement, certainly not compared to what we saw yesterday. But let's go ahead and pull up those boards. Here we are. The S&P 500 down about 0.2%. 59.37 is the level there. The Nasdaq down about 0.7%, a much bigger drop, 21,091. This is where I start to take some interest here because we did have Chris Waller speaking earlier today on CNBC. He said they're still going to try and cut rates this year if the data cooperates. He thinks it could be done, and he thinks not just 2, it could be 4. So we saw the 2-year yield come down 4.23, 4.24. The level there. And then NYMEX crude really coming down almost 2%. We had it over $80 at this time yesterday, and Brent obviously a couple dollars ahead of that. But it's coming off as maybe the market is betting maybe that Trump could be a little bit kinder on sanctions than the Biden administration was last Friday. Of course, it could go the other way if Putin doesn't do what Trump wants him to. But you see 78.65 on NYMEX.
Yeah, so overall, you wouldn't have thought there was much going on if you just looked at the index level. But in fact, it was a tale of two markets today. Plenty going on. Don't forget, next week is Fed blackout week. So we had some of the last comments we'll hear from anybody involved with the Fed from Governor Waller today. So he injected some life into the Treasury market, bringing yields down. But then in terms of stocks, we also had plenty of big movers, right? So you had results from United Health Group. They did not do so well. They were the worst performer in the S&P 500 for most of the day, down 6%. The medical loss ratio, which is the all-important ratio, was too high. It was coming up on 87+%. Now, if you're a claimant, you don't really care about that number, right? You want to get paid. But if you are the insurer, you don't want that number to be getting higher, and that really disaffected some of the investors out there. Texas Instruments and Taiwan Semiconductor, the tale of the two chip makers, right? So Texas Instruments coming under pressure because China has decided to probe U.S. subsidies and also U.S. exports. Obviously, this is getting in front of anything that the Trump administration might do executive order-wise and beyond. But then you had Taiwan Semiconductor ADRs rising 3.9%, and that helped the stocks, obviously. Taiwan Semi coming out with results saying that they were going to spend more on capex. That helped AI tool makers and chip tool makers do well. And also, it bodes well for the big AI companies. Not that NVIDIA had a green day today, Matt.
All right, let's go from there to trucking. I guess you got to put the chips somewhere to get them across country. J.B. Hunt shares down 2% here following results. We saw a big miss on EPS, but they were bang in line on revenue. Let's find out what that means. Lee Klaskow joins us from Bloomberg Intelligence. He covers transportation and logistics for us. And Lee, like I said, $1.53 on EPS is a miss by 10 cents from what the street was looking for, but revenue was in line. So are they at least doing as much business as the street thought?
Yeah, I think the majority of the miss that we're seeing in the fourth quarter is really being driven by their brokerage business. The brokerage business lost, I guess, more money than expectations were on the street, and that was really probably driven by more volume declines than expected. Volumes were down 22% in that brokerage business versus expectations for volume to be down 17%. They're dealing with some churn of customers. They acquired a business earlier in the year, and that's kind of been the story there. I think expectations were for a loss, but that loss just was a little wider than expectations were. The other businesses, that we're looking at right now, they're truckload and intermodal businesses. Their EBIT came in slightly above expectations, so that's good news. So it's not all bad news here. I think the brokerage business just weighed down the results in the quarter.
Lee, what does the prospect of a ceasefire in the Middle East from Sunday do for the likes of a J.B. Hunt when you offset that with the prospect of tariffs?
Yeah, so there's a lot of moving parts here about, what 2025 is going to look like from a freight environment. Obviously, if there is a true peace deal in the Middle East and the Suez Canal, and it's a big if the Houthis let ships go through the Suez Canal, that would create a lot of slack capacity in the container liner market, and that would drive container liner rates significantly lower because they wouldn't have to go around the Cape of Good Hope anymore, and they'd be able to save 10 to 12 days at the quicker route through the Suez. So, what you would see is an increase in slack capacity and a lot lower rates, which would flow through, the supply chains and shippers' expenses as well. So it could be a deflationary thing happening in 2025. And it is a big if, though.
Big if, exactly. And of course, there are those energy prices to contend with as well. Lee, thank you so much. We'll let you get back to those J.B. Hunt results. That's Lee Klaskow of Bloomberg Intelligence. But we're going to continue looking at this now with a broader outlook on the transportation and logistics market. Let's bring in Craig Fuller, founder and CEO of Freightwaves. So, Craig, we've had many different items in the last few days that have changed the prospect for shippers and just freight in general. What's your big takeaway from the news of the last 48 hours?
Yeah, I think specifically, Lee nailed J.B. Hunt's challenge. It looks to be in brokerage. I would argue that it's probably not a bad thing for J.B. Hunt. They probably have been positioning their business for the upturn and the end of the freight recession, which we have already started to see signs that the freight recession is over with, that market's improving. And this is the time when trucking companies, particularly those that have large asset-based operations, end up positioning themselves for the next part of the cycle. So the fact that they are, some of that brokerage business has churned out, I actually think is a healthy thing long term. This will be the last quarter of the freight recession from our point of view, and they want to be positioned to take advantage of higher rates as they come as the market improves.
Is there any benefit to Trump 2.0 to these truckers? We talk about deregulation, and antitrust concerns as it relates to a host of other industries. Does it help them?
Well, antitrust isn't an issue in trucking at all. And, if you look at J.B. Hunt's business, it represents less than 5% of North America's surface freight and probably closer to about 3%. So that really isn't a factor here. What I do think is real positive is tariffs are actually bullish for trucking, because what will happen is that it will encourage importers to hold more inventory domestically, to position products. We saw this in Donald Trump's first tariff implementation, as we saw a pretty strong bull market as the shippers prepared for those increase in tariffs. And then longer term, as we start positioning freight more towards North America, that significantly impacts J.B. Hunt's business to the positive, because they are predominantly domestic oriented and benefit when companies are looking at supply chain sourcing it in North America. And so I think it's incredibly bullish, and Donald Trump's policies are incredibly bullish for a J.B. Hunt. It's the international ocean container shippers that actually stand to lose more in a Trump economy than the domestic operators do.
It's been a tough couple of years for them, Craig. In the retail sales data that we saw today, we saw that people were pulling forward some of their purchases, right, because they were afraid of tariffs. So is there a chance that the freight carriers will notice that if people have already pulled forward some demand?
Well, really what drives the trucking market is really, particularly J.B. Hunt's business, but really broadly, is a lot of the retail spending and really positioning freight into warehouses What we've seen over the last couple of months, and really for the last year, is that shippers, whether it was the port strike and then really the reality that the election was likely to go towards Donald Trump and there would be increase in tariffs, they have been preparing by bringing and importing goods into the United States for the last year. That's why we're seeing record ocean shipping volumes come into the U.S. and the ports. And for a while, really up until October, the trucking industry was not benefiting from this high volume of goods because it was going into the network, into the distribution networks, and not into the last mile. What we've seen really since mid-October and certainly after the election is that a lot of those products are now flowing into the final mile, and this is really improving the state for domestic trucking. And so I think shippers will continue to plan on thinking about their supply chains domestically. And I think consumers, as long as consumer spending holds up in this part of the cycle, I think it's very bullish for trucking. The only sort of parts of the market that I would be cautious about is housing with higher interest rates and auto, which is a significant producer of freight. J.B. Hunt doesn't have an enormous exposure to auto, but some of the other parts of the transportation ecosystem do.
Let's broaden it out to, the industry and even beyond trucking, Craig. Usually when I talk to you on my program, Bloomberg Open Interest, every weekday from 9 a.m. to 11 a.m., we're talking about ports. And where are we on the automation debate here? Are we going to see more automation in U.S. ports?
Well, absolutely. In fact, what you saw is the union agreed to allow some degree of automation so long as there were jobs added as we added automation. And I think this is a win for everybody. Automation has felt like an inevitability, and it felt like the union's position was an extreme one to actually fight automation because the U.S. has some of the least advanced ports in the world. The fact that we were able to get some concessions on automation, I think, means that you'll have a more efficient supply chain. It means that more volume can go through the ports. They can handle more volume. And data itself and information will be more transparent. That's been one of the frustrations that a lot of companies have, is the automation also creates data and visibility of where products are. And when you don't have automation, you're dependent on humans, it's hard to know where products are at. So we will have a more transparent supply chain with automation, even if we're adding labor, because labor was a very small piece of the conversation around automation. A lot of it was about just having visibility and security at our ports. And I think what we saw in the union concession was actually a huge win for automation in the future.
Hey, quick, just got about 20 seconds, Craig, but quick question back to trucking. How far are we from automated trucking? I mean, how much longer do we need humans in the cab?
I think it's at least a decade out. This is a conversation that everyone loves to ask about. Autonomous trucks are inevitably going to happen, but we're still many, many years out before you'll see them on the highway.
All right. Awesome to get your intel. Thanks so much for joining us, Craig Fuller there, founder and CEO of Freightwaves. He's an awesome resource when you're talking about transportation and ports, and we always reach out to him if he has time. Intermodalities. Craig Fuller is the man for that. Coming up, the top three. We're going to focus on the top three movers and shakers at the center of the day's biggest stories next. This is The Close on Bloomberg.
Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And up first, Matt, Jane Fraser. Obviously, she's been in the news for the last couple of days, but cutting jobs, about 20,000 by the end of 2026. So not just this year, but also next year. It's already down about 10,000 year over year. But we are talking about a headcount of 229,000 people. So, there is a percentage there. And it's obviously continuing with part of her cost cutting plan.
Yeah, cutting jobs by 20,000 and also giving $20 billion back to shareholders. I'm watching Andre Ku Jr. He's an heir to one of Asia's biggest finance fortunes, and he's building a private credit firm right here in New York with backing from his billionaire family. It's called K8, and it'll be interesting to see if he can expand on his dad's $1 billion fortune in Taiwan by building a new empire on this side of the Atlantic.
You think it's K8 after the mountain,
or do you think it's Kate?
I mean, either way, he's trying to raise at least $50 million from investors, which is not that much, but he's targeting a 50% return on each $5 million investment that he makes. So that's pretty ambitious. I like to see the ambition in, those with $6.3 billion in their family dynasty. I'm also watching Hollywood because Donald Trump, president-elect, has said that he wants Jon Voight, Mel Gibson and Sylvester Stallone to be special ambassadors to a great but very troubled place, Hollywood, California. He says they'll be his eyes and ears, which is a little bit troubling, but he also says that it will all end up in bringing back the golden age of Hollywood.
Jon Voight, huh?
I mean, if he was my eyes, I might be a little concerned, but great actor.
Coming up, employers and labor unions are bracing for a tough year of negotiations. We'll get more insight on the state of labor. All right, as the process to approve members of the president-elect's cabinet heats up, both sides of the aisle are looking ahead to the confirmation hearing for Labor Secretary nominee Lori Chavez DeRemer. She's reportedly been making the rounds on Capitol Hill this week and even meeting with representatives from fast food chains to discuss wages and unionization. It's an integral role to fill, especially with nearly 200 large union contracts set to expire this year. Joining us now for more on this is Seth Harris, senior fellow at the Burns Center for Social Change and, of course, former labor secretary as well. Mr. Secretary, thanks so much for joining us. Let me get your take first on the nominee. And I feel like she's going to get some really strong bipartisan support here.
I think you are exactly right. I would guess that she could get the largest vote to confirm in the United States Senate. Democrats don't have a compelling reason to oppose her. There are some Republicans who are nervous about the pro-union positions that Congresswoman Chavez DeRemer took in the House of Representatives, but I think it's going to be very hard for them to vote no unless the business community comes out against her, and they're not going to want to risk the wrath of Trump. So I think it's likely that she will get a very large confirmation vote in the Senate.
It's interesting to imagine how this incoming Trump administration will deal with unions, because typically Republicans are more business friendly. This is obviously a much more populist Republican Party now. How do you think, those unions that are trying to renegotiate contracts, what kind of support are they going to get from Trump?
I think they'll get almost none. The president was supportive of the longshore workers when they were not on strike, and he has a long-standing relationship with the head of the International Longshoremen's Association. But as a general matter, President Trump has a consistent record of being anti-union, and despite the appointment of Congresswoman Chavez DeRemer to the Labor Department, what really matters for the Labor Department is for the labor movement is the National Labor Relations Board, the Federal Labor Relations Authority, which is the NLRB for the federal sector, and what's going on in the states. President Trump, I think, is going to take a very traditional anti-union, pro-business position when it comes to collective bargaining and worker organizing.
So how does the face of the NLRB change over the next couple of years, Seth? And also, what are the big operations we should be keeping an eye on now that we know that some of these strikes have got settled?
Well, the NLRB is going to go from being among the most aggressively pro-worker, pro-organizing, pro-union NLRBs that we have seen, including the General Counsel, Jennifer Abruzzo, who's done an outstanding job, to an anti-union, anti-worker, anti-collective bargaining organization. I think they're going to do most everything they can to frustrate unions, to frustrate workers who are trying to organize, and they will not be playing a beneficial, salutary role when it comes to collective bargaining. Now, there's a significant question about how much that ultimately will matter, and I've been talking to union organizing directors and others. They know what's coming, and they were planning on a fairly dramatic shift in their organizing strategies anyway. So I think it's not entirely clear that Trump is going to be able to keep workers from organizing, particularly in this era of heightened worker activism and heightened worker militancy.
Yeah, and when you think of sectors, I'm thinking of the education sector, I'm thinking of the airline sector, perhaps the grocery sector, all contracts that potentially expire this year.
Yes, no question about it. There are 4 sectors to keep an eye on. There are no really big national negotiations going on. Starbucks is sort of old business from 2024. That will continue into 2025. There's a lot of tension between the parties there. There's a bunch of stuff going on at the Postal Service, the United States Postal Service. Those workers can't strike, but they're now negotiating with the Postal Service. But there are 4 sectors that we should be keeping an eye on, not for big national contracts, but there are a lot of large regional negotiations going on, and that is, as you said, education, healthcare, groceries, and the airlines. The airlines operate under a different law that makes it extraordinarily difficult to strike, but there's some real conflict going on there. So big brand name airlines like United Airlines are a big fight with their flight attendants, and I think we're going to be hearing a lot more about that. I should also mention there's a big organizing drive underway at Delta Airlines. I think we're going to be hearing a lot more about that in 2025 as well.
I want to play a shot that we had, soundbite from our interview yesterday with the former president of the St. Louis Fed, Jim Bullard, where we asked him about the potential effect of tariffs and mass deportations on inflation. Listen to what he had to say.
I think the story that tariffs are going to raise inflation, I don't think that's a good one. It's not something to bet on. I would also say that the immigration story is not a good one to bet on as far as inflation outcomes. I mean, you could study monetary theory for 3 decades and you probably never hear anything about tariffs or about immigration having an important impact on inflation. So I think those stories, came out of the campaign, but I don't think either one of those will have any lasting inflation implications.
What do you think about that, Ms. Secretary? I mean, you spent many years in service in the government under Obama, under Biden. You went to Cornell, taught at Cornell. You're a distinguished professor of practice at Northeastern University. Do you ever hear about immigration having an effect on inflation?
Immigration is the reason that our economy has been growing. We don't have enough workers here in the United States, so we need to bring in workers from around the world. If we start throwing people out of the country, people who are being productive, who are contributing, and disrupt their employers, disrupt their communities, scare their families, that is going to have a negative effect on economic growth, and it is going to increase the likelihood that inflation is going to go up, mostly because production is going to go down. I'll be honest, I have no idea what Mr. Bullard is talking about with respect to tariffs. If tariffs are very narrow and tightly targeted, I think he might be right that they are not going to be inflationary. But President Trump is talking about blanket tariffs, all Chinese products, all Mexican and Canadian products, all products that come from overseas. If we see anything like that, of course, tariffs raise prices. The tariffs are paid by the companies that import goods into the United States. They pass as much of that cost along to consumers as possible. And so prices are going to go up. I don't understand the economic theory behind his argument.
Thank you so much for joining us, Mr. Secretary. Seth Harris, Senior Fellow now at the Burness Center for Social Change.
All right, we have some important news crossing the terminal. Moments ago, the Supreme Court sets tomorrow as opinion day on the TikTok case. We have been waiting for a decision and thinking it must come by Friday, right? Because the deadline that Congress legislated for TikTok to be sold or shut down, at least for U.S. access, is Sunday. And I feel like the justices probably don't want to come into work on Saturday or Sunday, so they've got to give us a decision, and they say now they're going to do that tomorrow. This is Bloomberg.
The United States is not going to default on its debt if I'm confirmed. The FOMC should be independent. I will be 100% on board for taking sanctions up, especially on the Russian oil majors. Americans are barreling towards an economic crisis at year end. If we do not renew and extend then we will be facing an economic calamity. On CBDCs, I see no reason for the U.S. to have a central bank digital currency. I firmly believe that if confirmed and with your counsel and support, we can usher in a new, more balanced era of prosperity.
That was Scott Bessent earlier today at his confirmation hearing for Treasury Secretary. Joining us to discuss further is Jon Lieber, Managing Director and Head of Research at Eurasia Group. So John, Ian Lingen of BMO saying that Bessent showed himself to be the adult in the room today and that he actually performed quite well. What were your takeaways from the hearing?
Yeah, I mean, I think that Bessent is clearly kind of the adult version of Trump economics. And that's the spin he's been trying to put on this for the last year as he's auditioned for the job. And now we look at that in kind of its most sophisticated form. So there were a couple of surprises there, indicating that he's going to increase sanctions on Russian oil majors is something that I think, wasn't obvious that the Trump administration would try to do. Although a lot of Republicans have been complaining that the Biden administration kind of left them off the hook there. I think he talked about the debt limit and potentially eliminating it. This is something that's clearly been on President Trump's mind. Probably hard to get the votes in Congress to do that, as many members of Congress see the debt limit as a way of controlling the debt and holding the executive branch accountable. But would be an interesting development if that's something that President Trump did try to push for. He didn't really have a lot to say about tariffs. I mean, Bessent's been the voice behind the idea of gradually increasing universal tariffs. And we didn't really hear a lot about that in this commentary. But I think tariffs are still going to be one of the main stories of the next few weeks as the Trump administration starts to roll out their economic agenda.
Yeah, we'll definitely be excited to get more news on that, John. And rest assured, we will make a big deal out of every single sentence that comes out of the Trump administration having to do with tariffs. I wonder about the Tax Cuts and Jobs Act specifically. Scott Bessent said this is the single most important economic issue of the day. Last Wednesday, the current Secretary of the Treasury, Janet Yellen, said if we get a full extension of the tax cuts, that could undermine our country's strength, from the resilience of the Treasury market to the value of the dollar, even provoking a debt crisis in the future. Is this politics, or is this just two different economic viewpoints of tax policy?
Well, certainly a $4.5 trillion tax hike taking effect in 2026 would be a pretty big deal if it were to happen. And I see the future Treasury Secretary's comments as being about framing of those tax hikes, because this is a big hit to the deficit. And what the Republicans, I think, are going to try to do is say that, hey, this is not really a deficit hit. We're just trying to keep current law we're trying to keep current policy where it is. So by reframing the expiration of the Trump tax cuts as a tax hike, they're making it easier to extend them and make it easier for them to not have to worry about that big deficit hit. Now, of course, both are right. Yellen and Bessent are both correct here. This is a potential, the U.S. debt is a serious issue, and the tax cuts are going to exacerbate that. And Bessent's right that, in fact, this is a tax hike on the American people. So the framing here does matter because it gives permission to Congress to either care about the debt or not. So I think that's where this really plays out next year.
Yeah, I mean, there were a few things that were just slightly at odds with one another, right? He said that the currency will strengthen, consumer preferences will change, and foreign manufacturers will continue cutting prices. Therefore, any inflationary impact of tariffs will not be passed on to consumers. He also said that he's not in love with CBO scoring. So he was throwing a lot of things out there that he can use to defend himself, whatever happens. But the Treasury market certainly took this testimony as a positive sign, right? We're back down to 460 on the 10-year. Can Bessent keep it there and perhaps even lower and help the Fed as well, which he says should be an independent body?
I mean, there's a bit of irrational exuberance around the U.S.'s long-run debt picture. I mean, it's bad, and it's only going to get worse. And even if you did end up raising some people's taxes next year in the extension of the Trump tax cuts, it's more likely than not that the Trump administration is going to end with a higher annual borrowing cost than a lower annual borrowing cost as a share of GDP. So, I think that there's obviously the U.S. has a large and rich tax base. It's got a very productive economy. There's always reasons to believe the U.S. is not going to default. But if you're looking only at the debt burden, it's going up. And nothing the Treasury Secretary says is going to affect that, because the reality is that no one in Congress is willing to cut entitlement programs, and Republicans don't want to raise taxes. So that debt burden's going up. You'd expect interest costs to go up. You'd expect rates to be a little bit higher and inflation to be a little bit higher with the rest of the Trump agenda and immigration, which you were talking about before, and of course, higher tariffs. So, I think long run, we know the direction of travel here. There may be some steps along the way that affect the Treasury costs.
I want to ask you about some of the Biden administration's parting shots, John. As he gets into the final week of his administration, President Biden is pushing a lot of things through. Some seem a little silly, like the SEC bringing a suit against Elon Musk that clearly is going to be over next week. Others maybe are going to stick. We just got headlines that Rivian, for example, is going to get up to $6.6 billion to build an EV plant in Georgia. Plug Power is going to get a $1.7 billion loan guarantee for hydrogen plants. They're just shoveling out some money here from the Energy Department to try and do something for clean energy, because they expect, I guess, the Trump administration to do less for clean energy. Do these things get reversed in the first week?
I don't think so. I think the money out the door is money out the door, as you say. There is room for the Trump administration to move quickly on some of the Biden's green energy initiatives. We would expect the LNG export pause to be reversed. It's possible that the kind of creative interpretations of the Inflation Reduction Act that allowed auto manufacturers to access the tax credit, foreign auto manufacturers to access the EV tax credit through their leasing arms, probably gets reversed at some point. So there's going to be movement around the edges here. But, the Biden administration's been really busy since the election. And you are seeing this flood of new actions coming, whether it's these lawsuits. The CFPB has been very busy. The SEC has been very busy. The FTC has been very busy bringing a lot of lawsuits. A lot of this is about putting stuff out in the public record so that either future plaintiffs know about it or consumers are educated about it. And I think that's an important theme of what the Biden administration is trying to do here, is just set the records, set a public record by the government kind of, accusing Elon Musk of securities fraud, et cetera, and then kind of letting the chips fall where they may once they're out of power. I wouldn't expect the Trump administration is going to continue a lot of these lawsuits and regulatory actions, though.
All right, John, great to get your take. Appreciate your intel. Jon Lieber, Managing Director and Head of Research at Eurasia Group. Now, another person that we've been watching today, that we've interviewed today, is Palmer Luckey. He's the founder of defense tech startup Anduril, the founder of the $14 billion company, picking the great state of Ohio as the location of a new manufacturing facility. He spoke with Bloomberg's Ed Ludlow in Columbus about the latest move and also his relationship with another Ohioan, Vice President-elect J.D. Vance, who was an early investor in his company. Here's part of that conversation.
The types of threats that the United States is facing, that our allies around the world are facing, the fact that we are predicted to run out of munitions within the first 8 days of a potential conflict with China mean that we need to hyper-scale our manufacturing of these types of weapon systems.
But why Ohio? Was this the only state that could guarantee that timeline?
I think that they were the state that gave us the best shot of hitting that timeline. Look, we've really engaged well with Jobs Ohio, with a lot of the politicians here, not just at the state level, but the local level. Like you said, we're hiring 4,000 people here in direct jobs, a lot more jobs than that in an indirect capacity. It's the largest single job creation event in Ohio history. It was a state that told us, we have the workforce. We have 1 million people who are capable of working in this facility within a 45-minute drive. We're willing to work with you on higher education to help train people so that they can come in and they can work with you. Our customer in the form of the United States Air Force obviously has a huge presence here in the form of Wright-Patterson Air Force Base. So really all the stars align to make Ohio a great place for us to do it and to do it fast. And speaking candidly, as someone who is from California, there's some states that are really good at pushing you out and slowing you down, and there's others that are great at pulling you in and speeding you up, and that's what Ohio was.
Let's go there. Was California at any point a likely candidate, and if not, why?
There was a 0% chance at any point of Arsenal 1 being located in California. There's a lot of reasons for that, but you can go through them. It's the high cost of living. It's the very high energy costs. It's in some cases the unreliability of the energy systems. It's the unreliability of the state politics and the worry on the regulatory side.
That was the founder of Anduril, Palmer Luckey, talking to Bloomberg's Ed Ludlow in Columbus, Ohio, one of my favorite cities in the world. And he had a super cool drone, Vonnie, sitting behind him. Looks like it was called Fury.
I mean, I thought it was an aircraft, but apparently it's an autonomous air vehicle, whatever that means. I guess you could call that a drone. 5.2 millimeter. Could that be wingspan, 17 foot?
5.2 meter wingspan.
Meter.
It's,
All right,
it's more than 5.2 millimeters.
That's what I was thinking.
I did a deep dive on Palmer Luckey today because I looked up at Ed Ludlow's interview and I thought, who is the dude with that hair?
Yeah.
And he's one of these super geniuses, right? By the end of high school, he was already making like virtual
Oculus
reality
VR,
systems.
yeah.
Then he made Oculus, sold that to Facebook. And now he's doing Anduril, which makes drones like the one that you saw behind him, Fury, and also sensors. And he's gotten massive, like billion-dollar contracts from the U.S. government.
Ohio is turning out to be a really stealth state. I mean, you know who else lives there, right?
Are you talking about Mike Tyson and
Dave
Stephenville?
Chappelle.
Dave Chappelle, obviously. Well, I went to Antioch College in Yellow Springs, Ohio, so
well then,
I spent some time with Dave
you know
there
the
as well.
beauties of Ohio.
And of course, we have Intel building a massive facility in Ohio as well. David Weston for Wall Street Week went there and talked to some of the people setting up that factory. So, yeah, it's a really fantastic place to be from. Still ahead, what investors need to watch for over the next 24 hours. Vonnie and I will give it to you. This is Bloomberg. Let's take a look at what's ahead, what we're watching over the next 24 hours. We are awaiting a rocket launch.
The 7th flight test of SpaceX Starship. The goal of this one is also to get the rocket booster, the super heavy rocket booster back, and they're going to be using mechanical arms. And this morning, Jeff Bezos' outfit didn't manage to have its heavy rocket booster land on a barge in the ocean. So we'll see if SpaceX can do it this evening.
They took off, and their first goal was met, but their secondary goal was a failure. We've seen the chopstick landing before from SpaceX, and it'll be totally cool to see if they can do it again. At 9 p.m. tonight, there's a bunch of data coming out of China, including GDP, industrial production, retail sales. If you're an investor in China, watch that. And then we get some Eurozone data tomorrow.
Yeah, Eurozone data early in the morning when Matt's getting into work, and then a couple of hours later, we're going to get U.S. housing starts and industrial production 45 minutes after that. Of course, the TikTok news out of the Supreme Court could come tomorrow morning, too.
Yeah, join me actually tomorrow on Bloomberg Open Interest at 9 a.m. Have a nice night.